The new tariffs are already reshaping the flow of goods across the 8,800-kilometer border. Industries that depend on just-in-time deliveries say they've been forced to slow shipments, renegotiate contracts, and in some cases, halt exports altogether. For Canadian exporters, the cost of shipping into the U.S. has surged, but it's not just the tariff percentage itself, it's the uncertainty behind it. Many are now hiring trade compliance experts just to navigate the complex rules of origin that determine whether a product qualifies for exemption under the USMCA. The ripple effects reach far beyond manufacturing. Canadian seafood processors in Atlantic provinces say orders from American distributors have slowed dramatically. In Western Canada, grain cooperatives report U.S. buyers walking away from forward contracts signed months ago. South of the border, reaction is mixed. Some American producers, especially in steel, dairy, and lumber, are welcoming the move, saying it levels the playing field. But importers who rely on Canadian components say the tariffs will raise their own costs and could lead to layoffs. Trade experts point out that tariffs often hit the very industries they aim to protect. When input costs rise, companies either pass the expense on to consumers or cut production to absorb the losses. Neither option, they say, is a win for the economy. Diplomatically, though, Canada has lodged a formal protest through the U.S. Trade Representative's office. Officials in Ottawa are exploring countermeasures, but stress they want to avoid a spiral of retaliation. The memory of the 2018 steel and aluminum dispute, at the time also with the Trump administration, saw billions in tariffs imposed on both sides, and that threat still looms large. On the ground, businesses are making quick adjustments. Some are rerouting shipments through third countries to sidestep the tariffs, a move that's legal if goods are substantially transformed along the way, but which add time and cost. Others are looking inward, seeking to replace U.S. buyers with domestic or overseas markets. That's easier said than done, though, as many Canadian exporters have spent decades cultivating relationships with American partners, building supply chains that cross the border multiple times before a product reaches the consumer. Economists warn that the broader danger lies in the erosion of trust, however. Predictable trade rules are the backbone of cross-border investment. When policies shift abruptly, companies often pause expansion plans or cancel them outright. For consumers, the effects may take months to appear, but when they do, they'll likely show up in higher prices for everything from cars to groceries. Some retailers are already adjusting their pricing models in anticipation of steeper import costs by year's end. Even industries not directly targeted by the tariffs can feel the strain. Logistics companies are reporting a drop in shipping volumes, while banks are reassessing risks for clients with heavy exposure to cross-border trade. Meanwhile, political analysts say the decision is as much about messaging as it is economics. It sent a signal to voters in industrial swing states that the administration is willing to take aggressive steps to protect domestic jobs, even at the risk of alienating America's closest trading partner. For now, Wyatt Sharpe, the News Forum.